Welcome, everybody, to the Retirement Power Hour. My name is Joe Allaria, and this is episode 4. And as you can see, if you're joining us via video, I'm going to be joined today by Jay Waters. Jay, welcome back to the show.
Yep, Joe, thanks for having me, and I'm looking forward to our conversation today.
So, Jay, you were on the first episode, which was back in January, the premiere of the Retirement Power Hour. So what's been new in your world since?
Not a whole lot. Been doing a little bit of traveling. Got back from Florida about 2-3 weeks ago, and then heading out to Myrtle Beach about a week and a half from now. So doing a little bit of travel in this first quarter.
Very nice. Very nice. What's in Myrtle Beach? Just for fun? Family trip or what? What's going on?
Just for fun, visiting some friends, and then when we went to Florida, I actually got engaged. So no golfing for the warm weather, but got engaged. So all good everywhere around.
Yeah, and I did know that, obviously, but congratulations. We'll say it publicly. Congratulations to you and your fiance. That's awesome.
Thank you. What about you? What's new in your world?
Just looking forward to playing, getting outside, a little bit warmer weather, and not being holed up in the house like we're all winter. So that'll be nice. But I did go. We were able to go skiing a few weeks back, so that was a good time. Jackie and I went. So. Today, Jay, we're talking about bear markets and strategies for a bear market, but I think it's important to preface that with the fact that we are not in a bear market. So I've had a lot of conversations with clients as when they've come in for meetings lately, and it seems like most people think that we are doing worse, or I should say the market is doing worse than it actually has. And of course, the market could go back down from where it is today. But we're recording this. It's April 4th, and year to date, we are not even in the negative double digits at this point in time. So, in our world, for the most part, nothing out of the ordinary. We love to see black numbers, not red numbers, but for the most part, nothing too out of the ordinary. Now, as far as bear markets are concerned, what back when I scheduled this topic, there was the Russia-Ukraine thing had just come out, and we thought, hey, we easily could be in a bear market. So we wanted to talk about this. I did a virtual presentation in 2020 after the COVID decline, which was a very steep decline, as I'm sure most of those that are watching can remember. But we talked about different things you can do when the market does decline. And I guess we should probably start out by defining a bear market. So Jay, I'll kick that off to you. Could you explain for all the listeners just what is a bear market?
Yep. So a bear market is a 20% drop from the most recent high in the market. And same thing for a bull market, right? From most recent low, a 20% increase.
Okay. So, and it sometimes can be confused, right? With a recession.
We see that a lot where clients or just people in general will tie hand in hand a recession and a bear market.
Yeah.
Where, again, bear market is a 20% pull down, where recession doesn't really have anything to do with the stock market. It has more to do with GDP. And a recession is defined by, 2 negative consecutive quarters of GDP. So,
yeah.
One way or the other, if we are in a recession, it may not have adversely affected the stock market with the 20% decline. And same thing, we may have a 20% pullback, but we might not be in a recession. So
right. And we saw that in 2020. There was a period of time the economy was at a complete screeching halt, and the market did come down, but we came out of the bear market pretty quickly, whereas GDP did not recover as well. So they can be correlated, but they're not the same. But nevertheless, there are times when the market does decline 20%, and that is really to be expected. So we wanted to first set the stage of not only what a bear market is, how often do they typically show up, and what really any investor should expect when we're talking about being invested in the stock market. What's, quote, normal, and what is, I guess more of a cause for concern. But even when we say things are normal, it doesn't mean that we're robots and we don't feel the stress of investing in a crisis. And that was episode 3. So if you want to hear a lot more about the behavioral side of investing in a crisis and in a bear market, I would really encourage you to go back and listen to episode 3, because we spent a ton of time. Mark and I were talking about this. Mark Allaria here, another advisor at CarsonAllaria Wealth Management, talking about the behavioral side of investing in a crisis and how to avoid making really big mistakes. But that's not really our focus today. Today is more about strategies that you can use. And so again, we're talking about bear markets, and we're going to kind of go into, well, they're normal, it's expected, but we get it. It's uncomfortable. But sometimes it helps to get a little perspective and look at it from the numbers side. So Jay, I will quiz you a little pop quiz. I'm not going to give you any hints on this one, but I'm just curious. We're going to talk about how frequent the different drops are. So if you had to guess, Jay, how frequently does the S&P 500, the Standard & Poor's 500, how frequently does it decline by 5% or more? How frequently? How many
times a year?
How many times per year, or how many years? What do you think?
Yep. 5%, probably 2-3 times a year.
Exactly right. 3 times a year. Good. And the length of that decline is about 46 days. So for the market to drop 5%, that happens on average 3 times a year. And that's from 1948 to 2017. This is information put out by Capital Group, by the way, capitalgroup.com. We'll put the link in the show notes so you can see all this information. And the same goes for a 10% decline. That happens about once per year. And 15% happens about once every 3.5 years, a 15% or more decline. So Jay, again, what about a 20%? 20% is that bear market. So how often do you think a 20% or more decline has happened? How often does that happen on average, going back to 1948?
I'm going to get a little wider range, probably 6 to 8 years.
6 to 8 years. Well, I'm going to give you half credit for that. No, you're exactly right. It's 6.3 years. So about every 6 years, or just over 6 years on average, the market will decline by 20% or more. So they are more common than people might think they are. And the biggest thing that we need to avoid, again, talked about it last episode, the biggest thing we need to avoid is a behavioral knee-jerk reaction in the middle of that. And what I mean is people getting out of the market, people saying, we're down 20%. This is not good. This is going nowhere fast. I got to get out of the market, because the average 12-month return after a steep decline like this, after a decline of 15%, the average 12-month return has been 55%. So that's pretty significant. You know, if you look again, this is going back again, you can look at the show notes. You can see where this data comes from, but the subsequent 12-month return after a decline of 15% or more in the market is 55%. So if you get out of the market when things are bad, there's a decent chance that you're going to miss out on a really, really, really strong return.
Yeah, I couldn't agree more, Joe. And, you know, when it comes to, you know, you talking about people maybe jumping out of the market, it's impossible to time when the market's at its high, but it's also just as impossible to time it when it's at its low.
Right.
To get it right, you'd have to guess correctly, not only on when to sell, but also when to buy back in.
And it's when the market is going down, and I can think back to 2020 when the market was down 20-30%, it feels like it's going to go down 60%. I mean, when things are bad, they feel really bad, right? That's what causes the first 20% decline. But somewhere along the line, historically, things have turned around. And, you know, we'll just keep sharing some of these statistics here. The average bull market, so when we talked earlier, the average bull market lasts for 71 months and has gone up, I should say, 263% cumulatively. So that's obviously not per year. The average bear market lasts 14 months and goes down an average of 33%. So these bear markets last nowhere near the duration that bull markets last, historically speaking, and they go down nowhere near the amount that the bull markets have gone up. So that's the historical picture and the perspective that we hope that you take away from this if you're listening, because we are going to talk about strategies in a bear market. But first, just understand they're common. They are typically short-lived. When you look at this, is a lot of data. This is going back a long time. And I think the mistake that investors can make is, again, the market goes down, they take the money out, they want to wait till things get better and then put their money back in. But guess what? If you do that, you miss the upside, and it could very well be too late to regain any of what you missed out on.
Yeah. And I think it's important to go over those numbers though, Joe, like we are going over, how long does a bull market last and what's the average on a bear market?
Yeah.
Because if we educate and if our clients are knowledgeable of those, time periods, then when that time comes, it goes, oh, it's almost like, hey, this is supposed to happen.
Right.
It's nothing out of the ordinary. We know that the market should pull back probably around 20% every 6.3 years, like you said. And it's just,
right.
If you know that those are the expectations, then when that time comes, it's a lot easier.
Absolutely. 100%. And we don't have to understand everything about what makes or drives the market up or down, or we don't need to even be experts, but I'm saying investors listening don't need to be experts in this, but just if you're out there listening and you know what is to be expected, like you said, Jay, then you're not spooked or freaked out when these things happen. Now, we on the advisor side obviously are not spooked or freaked out. As I typically explain to clients, we know the market's going to go down. We know we're going to have bear markets. We just don't know exactly when or why. So when COVID struck and the market just dove downward, that was not anything out of the ordinary from a stock market point of view. Of course, the COVID part of it was very unexpected and very new, just like many crises are. They're things that we haven't seen in a long time, or things that we maybe haven't seen at all. But the reaction and what happens in the market is not typically something that's unexpected. And the other thing to just remember is the market is not this really mystical system that's out there that no one can really understand or know about. It's really made up of people. And people, Jay, my belief and our belief, I think, is that people are smart, they are resourceful, they are able to bounce back from big tragedies. And when you tell the top companies in the world, or and you throw a challenge at them, these are some of the best that we have, some of the best minds. My money is on the fact that they're going to figure out the sort of new environment and figure out how to overcome these challenges, come out with products and solutions that the rest of us and the world still want to buy and still want, even if we do have COVID, even if you do have wars abroad or anything, these different challenges that arise, my money is that we as a people are going to continue to innovate and come out with things that other people are going to want to have. And that's the market. It's just made up of a bunch of people. And as I've said, if someone told me I couldn't be a financial advisor anymore, or because the government came out with a government sanctioned advisor robot, I'm not just going to go sit on my bed and cry about it and never come out. I might do that for a short time, but I'm going to use the skills that I have and innovate and try to and pivot and come out with something else. And there's a lot of people out there that are in that same position as a business owner who will do the same. But with that, Jay, let's talk about these strategies. We got 5 strategies today. When we're in a bear market, again, we are not in a bear market right now, but you might be listening at some point in the future where we are in a bear market. If you are, we know it's not comfortable. It's typically something that's not in your control, so don't fear. But there are a few things that you might be able to do to capitalize on the volatility of the market. And the first one, Jay, is tax loss harvesting, a strategy that the listeners may have heard about, but it really all stems back to capital gains and a way to reduce capital gains now and for the short term in the future. So can you just explain a little bit about capital gains, what type of accounts a capital gains tax might apply to?
Yep. So when we talk about tax loss harvesting, it's going to apply to brokerage accounts, individual accounts, not your IRAs, just individual brokerage accounts. And the way tax loss harvesting works is when you, let's take an equity, for example, and you sell it at a loss, you're going to then use that tax write-off or that loss of whatever you incurred, basically whatever you bought it for, your cost basis, minus whatever you lost. And then you can use that to offset some capital gains that you may have from selling an equity that you made money on above your cost basis.
So let me just pause there just for a second. So these are not IRAs, not Roth IRAs, but when we sell a security, a stock, a mutual fund, and we made money. So we bought it for 10 grand, we sell it, it's worth 15 grand. I had $5,000 of capital gains, and then the 5,000 I would have to pay capital gains tax on that 5,000, depending on my income.
Yep. And the brackets you have for capital gains, when we talk in that relation, you have three brackets. You have 0%, 15, or 20%. So when we talk to our people that are, let's say, married, filing jointly, right? If you make less than $83,350 joint, you're not going to pay anything on cap gains. If it's anything over that number, you're in the 15% bracket. And then anything
up to 517,200.
Yep.
Yeah. And then if you're above that,
20% bracket.
20%. Right.
Yep.
And this is all for 2022 to 2022 tax year.
Yeah.
And if you're a single filer, and by the way, we'll get to this. I guess we should mention this though, that these numbers are taxable income. So I'm going to ask you what the difference is in just a second. But taxable income for a single person, $41,675. If you're below $41,675, then you actually pay 0% capital gains tax rate. But if you're between $41,675 and $459,750, they could have rounded, I feel like, and made that a lot easier. But you'd pay 15%. So the moral of the story is most people pay 15% capital gains tax. Now, Jay, real quick, because this is based on taxable income.
Yep.
So what is the difference between taxable income, gross income?
Yep. So when they look at cap gains on taxable income, that's them saying, okay, you've made your standard deduction. You've taken your maybe some 401k deductions, pre-tax deductions. So it's whatever you're actually getting taxed on at the end of the day, not what that gross number is.
Yeah, not your adjusted gross income. So just because if you're married filing jointly, let's just say, and you had an adjusted gross income of 100,000,
right?
Well, and you even just took the standard deduction.
Yeah, which is 25.9 for this 2022 tax year.
Yeah, so you could still actually be in that 0% range for capital gains, right?
Yep.
So that's just important to differentiate, because a lot of these tax strategies really hinge on either gross income, taxable income. So it's important to know that. Now we can finally get to talking about tax loss harvesting again. So we talked about what happens if you have a gain. So when the market's down, someone may have an unrealized loss, meaning if they sold their fund, they would realize a loss. And that's kind of what tax loss harvesting is. But why would someone want to do that, Jay? Because I've always heard, don't sell. Why would you want to sell something at a loss from an investment standpoint? I've heard buy low, sell high, not buy high, sell low. So why would someone want to do that?
Right. There's a couple of reasons, why you'd want to do it. One of them simply could be you're just looking to rebalance your portfolio to the proper allocation and saying, hey, let's capture some of these losses to then offset some of these gains that we may have. The other way, or other reason you may do some tax loss harvesting, is you see a good opportunity, even though you are taking a loss on paper, then you can reposition that fund or that equity or whatever it is that you sold into something that is kind of similar, but not similar. There's
not identical. So,
not identical,
so from an investment standpoint, right, we don't want to sell and then just stay out of the market or not be invested. So some people might say, well, okay, this is great. I have $50,000 of unrealized losses. I'm just across different funds. I'm just going to sell all of them so I can lock in the loss. I'll just turn around the next day and just buy them right back. Can they do that?
No, you cannot do that. The IRS knows better than that. They
So
they do
yeah,
everything they can. So yeah, what that would be called then is if someone tried to do that, Joe, is the wash rule.
wash
So
sale, right?
yeah, wash sale. So wash sale is if you were to rebuy those same identical securities within 30 days of when you sold it. That you wouldn't be able to take that write off, or you'd have to. It'd be basically be a wash.
So when people try to implement tax loss harvesting, you can't sell it. They can't sell the security of the fund and then buy it right back. So what you had mentioned before, the strategy is you sell the position or the positions and you lock in the loss from a tax standpoint. But let's just say you had ABC large cap fund, or just a
Yeah,
certain sector fund that you could sell, and then again you could go buy XYZ large cap fund. Are they the
yeah,
same fund? No. Are they very, very similar? Yes, they're very similar. And you would do that because you don't want to not be invested. You don't want to sell and then have that and then stay out of the market for 30 days and have that fund rebound, and then you miss all the rebound, right? There's more. The main thing is the investment return. We
yeah,
don't want to let the tax tail wag the dog here and just say, well, I want to get the loss because that's great from a tax standpoint. Yes, it is, but you still lost money. So we don't want to lose. We don't want to actually lose money. So we want to stay invested. And we can do that by selling the one fund, locking in the loss, and then buying something else that's going to keep us in the market.
yeah.
And so it's important when you're doing that to try to make sure that, again, you can find something that's going to capture any rebound that might occur. But then those losses now they can go to work for you, and they can offset two different things. So what would be the first thing that these losses can offset, Jay?
Yeah, they can offset your capital gains from another sale of another security where you made money on that in your brokerage account. Or it could also be used for any other type of capital gains you may have. It could be maybe a rental property you sold, different source of income. You can take that loss and write it off towards
Right.
something else.
So maybe I already had gains in that year, or maybe I could do this, and then maybe the market rebounds, and I'm going to have gains later in the year. You can do
Yeah.
that.
And,
Actually, there's a third
and
option, and that's if you don't have any gains in that year. But what about 3 years from now or 4 years from now?
yeah, you can carry forward those losses into the future. And then you can also offset your income for that current year of up to $3,000.
Right. So you
Yeah.
can offset any amount of capital gains.
Yep.
But if you don't have the capital gains, you can offset $3,000 of income. So that's just your wages, whatever.
Yep.
And then let's just say I have $100,000 of losses that I locked in and no gains in that year that I did it. So I can use 3,000 of the losses to offset income. And I'm going to carry forward $97,000 of losses to the next year. That means if the next year I have $97,000 of capital gains, I can trigger all those gains and not pay any capital gains tax because those would wash out. So it
And
puts you in the driver's seat a little bit
yeah,
to have a little bit more control and a little bit of protection against the potential tax that you might pay. Again, you're not getting out of the market, so
yeah,
it's not hurting you from that standpoint. You're just giving yourself some losses, which could really help if you are in a higher tax bracket. Maybe you're going to use those losses while you're in your highest earning years, and then when you get to retirement, maybe you don't even have
capital gains.
capital gains tax because your taxable income is in the 0% range.
Yep.
So now you got all these losses that can just continue to offset your income at $3,000 a year. So gives you some more options. Now that's tax loss harvesting. I wanted to also mention quickly, which is not necessarily a bear market strategy, but tax gain harvesting, which talks to that. It speaks to that 0% bracket, that if I am a single person, again, the number for single person, I know we're throwing a lot of numbers out at you guys listening, but if I'm a single person, if I'm under 41,675 in taxable income, then I don't have any capital gains tax. I wouldn't owe any capital gains tax. And I've had this come up where single individual clients of mine have had taxable income of maybe 30,000, and they have unrealized capital gains, meaning that they hadn't sold anything yet, but they could sell it. And we've done that. So they're at $30,000 of taxable income. We could sell, $11,000 in capital gains, trigger that much in capital gains,
Yep. Pay
and
no
they wouldn't
taxes on it.
they wouldn't pay any tax. So you
Yep.
just sell it, buy right back. So there's tax loss harvesting, gain harvesting, but tax loss harvesting is the one during a bear market. Okay, Jay, that was a lot of information on tax loss harvesting. Let's go to the next one, which is Roth conversions. Now, what is a Roth conversion? Why is it good to do in a bear market?
Yep. Well, before I explain like what a Roth conversion is, I think it's important to set the table on the difference between probably a Roth and then a traditional IRA.
Sure.
So traditional IRA, you're putting into with pre-tax dollars that you're writing off. So take the write-off, gross taxable, you pull out taxable. Roth IRA, you go ahead and pay the taxes now when you contribute, but then as it grows tax-free, and then you can take out tax-free. So when we talk about then Roth conversions, you're taking your traditional IRA pre-tax money and converting it to a Roth IRA. So you're moving it from that taxable bucket to that non-taxable bucket.
Right.
And then why it makes sense to do it in a down market is whenever you do a conversion like that, that amount that you convert from your traditional IRA to your Roth shows up as income.
So that is taxable. If I
So
move
it is
over,
taxable.
if I move over $50,000 from an IRA to a Roth IRA, then I do have to pay taxes on that 50,000 at that time. Income,
Right.
ordinary income tax.
Right. So a good way to put a calculation around it is, it's better to, let's say you had $100,000 in that traditional IRA that you were going to convert over. So you're going to have $100,000 show up as income through this conversion.
Right.
Well, if the market's down 20 or 30%, well, that's, let's say it's down 30%. Now you're converting $70,000 instead of $100,000.
Same amount of shares.
Same amount of shares, just the shares are at a lesser value at the point.
Yep.
So then you would save, let's say you're in the 22% tax bracket. Well, you're going to save 22% then of that 30,000 that you would have converted.
Right.
Which is about $6,600 in taxable dollars that you would have had.
Yep.
Which you no longer do. So Roth conversions are always usually a good idea depending on the circumstance. But if you're already going to do a Roth conversion, it makes even more sense during a bear market.
Yeah. Yeah. And exactly. They could make sense in any environment, but it's kind of the icing on the cake, because what we expect after the conversion is that the 50,000, the 100,000, whatever you moved over. Let's use your second example, Jay. You converted, would you say 70,000?
70,000.
You converted 70,000, and the 70,000 was 100 shares of a specific fund, right? Well, the 100 shares were just previously worth $100,000. So what we expect is you convert the 100 shares over and you only pay taxes on the 70,000. The expectation is those shares would rebound back to their original value and then continue to grow. So the $30,000, the potential $30,000 rebound
is now tax-free. It's not
all is tax-free. So before it was all going to be taxable. The money declined in the IRA, then you moved it over, then it appreciated back in the Roth IRA. Now, there's no guarantee that rebound is going to happen and when it will happen and all that stuff. That's just investing in the market. But the expectation is, like we said at the beginning, these bear markets are temporary, or have been short-lived. So the expectation is that, yes, things would rebound. And I would much rather have growth in a Roth IRA instead of a traditional IRA. I want growth in both if I can, but I want as much as I can in a Roth IRA because all that growth is tax-free and that's all my money. The money in a traditional IRA, not all my money because it hasn't been taxed, and the IRS is going to lay claim to some of that. So moving on, Jay, the next strategy. So we've hit tax loss harvesting and we've hit Roth conversions. We've got 3 more to go. Number 3 is just portfolio rebalancing. And that could be something that would be good to do in a bear market. Now, just explain a little bit, if you could, Jay, what is portfolio rebalancing?
Yep. So, especially during a bear market, portfolio rebalancing, some sectors may get hit harder than others, right? You have large cap, you have small cap, you have value and growth.
Yep.
We saw it in 2020, right? Certain sectors got hit much harder than others.
Yep.
Towards the end of 2020, we saw a huge rebound in the value sector that we hadn't seen in a long time, and growth got hit pretty hard. So it's a good opportunity to capture some of those gains, buy low, sell high, and then just reallocate or reposition to that proper allocation that
Yeah.
you were initially wanting.
And maybe even stock to bond, because people
Right.
somewhat are familiar with, I've got some stocks and I've got some bonds in my portfolio. The old traditional retiree model, maybe that 60-40. Well, let's just say you wanted to be 60-40 going into the crisis. Okay. So you were 60-40, but then once we hit the, whatever the crisis is, your stocks, the 60% got hit harder than the bonds. So then all of a sudden you're sitting at a 50-50 allocation. Well, you want to be 60-40 and you're 50-50. So in that case, you might say to yourself, well, I'm going to sell some of the bonds and then move those over to the stock side because my allocation is too high in the bonds. It's not high enough in the stocks. So again, buy low, sell high. And that's portfolio rebalancing is good to do at any time. It could be a good strategy in a bear market. I will tell you, it is not comfortable. That's the hardest thing is on the behavioral side. It's just not comfortable to do that because we might see the market down 20% and say, hey, this is a great time to rebalance and move some bonds into stocks. Guess what could happen after we move more into those stocks? They could go down even more.
Yeah.
But we believe our belief is that, again, that would be short-lived. So it's often to try to separate the emotions out of these decisions and just, rely on logic but your money is personal and it's hard to do that sometimes. So that's what's good to have, to have an advisor, to have someone who's reassuring you that, yes, this is the prudent thing to do. All you can do is what's prudent. And a lot of people think, well, it's only prudent for me to get out of the market because the market's down 20%. And that's why it's prudent for me to protect my money. Well, I look at it and say, we have over 100 years of historical data that shows what happens after bear markets. We showed you earlier, the average 12-month return following a 15% decline is 55%. So in our minds, we're saying, well, no, the prudent thing is not to go to cash. The prudent thing is to buy as much in stocks or get as much in stocks as we possibly can.
Yeah.
And that's a good segue to our number 4 strategy, which is simply, if you are in a bear market and you have cash on the side, put your cash to work.
Yeah. And when we talk about putting cash to work, some people think, and it's easy to do, is you see it down 20, the market down 20%, and you say, well, I'm just going to wait for it to go down to 25 or 30%.
Sure. Why not?
And again, it's impossible to time the market, not only on when to sell at the peak, but also when to buy back in at the bottom.
Right.
To where it's just, you pick a point, and you say, hey, this is when I'm going to start putting my cash to work and I'm going to start buying stocks.
Yeah.
Because it's just impossible to time the bottom.
So yeah, what I would actually say too is, first of all, if you have cash in this environment, or this hypothetical environment that we might be in the future, the bear market, it might not be a good reason that you do have cash, because if you have been just waiting for this to happen, okay, that wouldn't be advised, because you could be waiting a very long time.
Yeah.
Like we said, in 2020,
yeah,
the market, we say the market, I'm going to just look at the S&P 500. In 2020, we got down, I want to say it was about 2,300 in the S&P 500. If you look around March, 2,500 in the S&P 500. March 23rd, looks like that was the close, according to my stock app on my phone. So roughly in that ballpark of 2,500. If you said, I'm going to wait until, because I think this thing's going down much further, right? And I'm going to wait until the market goes to $2,000, the S&P 500 goes to 2,000. Well, guess what? That never happened. And since that point in time, March 23rd of 2020 to again through here recently, we're up over 75%. The S&P is up over 75%. So that's 75% that you're not going to get back unless we were going to go down again, which again, it may never happen.
Yeah.
And the same thing happened after 2008, and the same thing inevitably happened after, every past downturn that we've had. We don't always return to those lows because, like we said, the bull markets last longer, and sometimes even with the decline, you just never get down to those previous lows.
And two things with that, Joe, is one, sometimes it stings even worse knowing what you missed out on the upside than if you would have rolled that roller coaster on the downside. So,
Well,
even if
should.
you do get it, even if you do get it, let's say you do guess it right, and you're like, hey, I got out right before it started dipping down, and I saved myself the 30% decline, but you never jump back in, and then it goes up 75%. Again, that sometimes stings worse than the 30% you saved from losing.
It probably should sting worse because again, how are you going to get that back?
Yeah.
At least when the market's down 30%, it stings. But the general consensus, especially in our view, is that, hey, this will recover and I'll get back to where I was. When you miss out on the upside because you were sitting on the sidelines, how are you going to get that back? You never will unless the market comes back down. So that's the hardest, to me, that's the hardest decision in investing to make. And you never want to force yourself to make that decision of, geez, I just missed out. Like we're sitting right now. Let's just say you're out there. We're going to give you guys some grace. Those that are out there that maybe, we're in that boat after 2020 and you thought the S&P was going to go down to 2000 and it never did. And you haven't got back in, and we're in 2022 now, and we've appreciated 75, almost 80% since that point in time. What are you going to do now? Do you just chalk it up to yourself and say, look, that was a bad choice. I messed up. I'm just going to count my losses and I'm getting back in because I don't want to miss out on any more. Or do you wait thinking, well, surely it's got to come down at some point. I can't tell you how many times I've heard that. Surely the market's going to come down at some point. Well, it will, but where is it going to come down from? Is it going to come down from where we are now? Or is it going to come down from where we are 50% from now?
Yeah.
And that's a question that we can't answer. And that's why we would say, if you have cash, put it to work, meaning invest it, diversified, low-cost portfolio, get it in the market, get it invested, because you just can't, you never know when that next downturn is going to come. And if you keep your focus on the long run, it really shouldn't matter.
Yeah. And to get it and to really quantify and say, hey, the market's going to come back to that, like, let's say it's 2,300 mark in the S&P, that's almost a 50% correction now, where before that time, it was only really a 30% correction.
Right.
And 50% corrections, although they are possible, they're not as common as your normal 20% correction.
Yeah. So it's a tough position to be in. Even if you missed out, you got out of the market for a week because you got spooked on, again, war news or whatever it may be. And, you saw the market was up 5% and you were out. If you have $1 million, 5%, that's 50 grand. So if you get back in at that point, you're basically saying, man, I just missed out on 50 grand and all the compounding that can come from it in the future because I jumped out. And you're in the same boat. Do I get back in or do I wait? So you don't want to put yourself in that position to make that call. But the last strategy, Jay, just in the sake of time, the last strategy for a bear market is something that is not very well known, but it's called a QHFD, Qualified HSA Funding Distribution. Now, this would only apply to people out there that do have an HSA, a health savings account. We have resources on our website at CarsonAllaria.com about health savings accounts, the benefits. But essentially, what this allows you to do is it allows you to transfer money from your IRA over to an HSA or a health savings account. Now, the HSA is the only investment vehicle that I know of where you can get a pre-tax, the money goes in pre-tax, so you get a deduction when you put money into an HSA. and then it can grow tax-free and be withdrawn tax-free. So this is similar to the Roth conversion strategy, which we talked about earlier. The benefits in a bear market are similar. If you roll money over from an IRA to an HSA, there's no taxes when you do that. You can do up to, there is an annual limit, an annual rollover amount that you can do. But
I think that number is what, 7,100 for that's small time. That's 2020 though.
yeah, I think we're up to 7,300 now for a family.
Yep.
For 2022. But when you do that, and if you did invest, because you can invest the HSA, then that's tax-free growth that you can get. So again, whatever the decline on that money, you move it over, then it grows. And hey, this might be something good to do in any environment. So if you've never heard of that, or you have an HSA and you would like to be funding it more, but you just haven't been able to, but you've got IRA money out there, this could be a really good strategy. Not very well known, but something that could make a lot of sense.
And you can only do that once in your lifetime, right, Joe?
Thank you. Yes.
Yep.
That is very important to know. It is literally a once in a lifetime
opportunity.
Literally. Yes. Once in a lifetime. And we are not making that up. So yep, check that out if you have an HSA, or ask us questions. But Jay, those are the 5 strategies. I can just extend out to anyone listening now. Let me remind you, we're not in a bear market right now. For anyone listening in the future that maybe you are in a bear market and you found this episode because you wanted some tips on it, well, we would encourage you to stay the course, to take some of these things into consideration, to sit down with an advisor. If it's us, if you're a client of ours, again, reach out, sit down, we'll talk through these things. We believe this too shall pass, and it has each and every time that the market has experienced these challenges. And I would again echo that the reason is not because it's just the market and we don't know what it is and it's a mystical being that no one understands. No, it's people, and people are resilient, especially as a group, as a society. We have overcome. We're all still here. We've overcome literally every calamity that's ever been known to man. We're still here, and I believe that will continue. And I think that bodes well for things like the stock market. So with that, Jay, thank you very much for coming back on the show for episode 4. It's always good to have you on and get your insight. Hopefully we can have you back soon.
Absolutely. Thanks for having me, Joe.
For everybody else, please make sure and visit our website at CarsonAllaria.com. And please, as a reminder, share this podcast on Apple iTunes, Spotify with your friends and family, to anyone that you think might benefit from listening. With that, we are looking forward to coming on our next episode and talking with Scott Carson, who is a former partner and a senior wealth advisor with CarsonAllaria Wealth Management. Scott is a 30-plus year industry veteran, and we're going to be talking about designing your retirement life. So it's one if you're near retirement or you're retired, you definitely want to tune in to that one, because we'll be talking about some interesting things there. With that, everybody, we hope you all are well, and we hope you take care. Until next time, we will talk to you soon. Bye-bye.